Hi there everyone, good morning. Thanks for starting your day with us. This is The Market. I'm Avan Dabash. With me, I'm Managing Editor Nikunj Dalmia in the studios and Nayantara Rai joining in from New Delhi. Well, it is D Day before B Day, and of course, there's a lot of focus on the markets and what the Finance Minister Nirmala Sitharaman has in store for us for the budget, which incidentally is the last full budget of the government's current tenure, and there is going to be a lot of expectations about delivering perhaps another growth-oriented budget. Well, ahead of that, the markets, at least for the first 2 days of the new series, have been somewhat disappointing. There has been that nervousness on Friday's trading session, followed by Monday's pullback that we saw around the 17,640 mark. But just mapping the kind of track record that we've seen over the past many years on the day of the budget, the kind of volatility that we've witnessed, we've seen that the intraday volatility has reduced. For instance, if we take it back to the year 2020, you had a 50 point intraday volatility. 2021, just about 700 points, but last year it was confined to just about 350 points. Nikunj, stepping into the budget this time around, of course, the big question is whether or not there is going to be any tinkering on the capital gains. But do you think that the budget linkage and the intraday volatility is only going to narrow?
You know, a week ago, I would have said the importance of budget in the overall scheme of things is actually reducing. But looking at the backdrop and the turn at which markets suddenly are at, I guess this year's budget will have a very strong swing factor in the short term. That's only because of the positioning of the market. That's only because of the way how, let's say, Adani Group stocks have sold off, how a Nifty has sold off. The market, in a sense, this time around is not very. There are sentiment, technicals, and compulsions which clearly are at play. And when you have a big event, and if you don't come on the right side of the event, then we could be in for downside stroke volatility. Yes, it could be technical driven, it could be because of sentiment, but this time it's the positioning of the market which in a sense may just be causing some extra dimension of volatility on the budget day and maybe couple of days after that. Now let's understand the context of the budget per se. Awan, frankly, this year's budget backdrop is strikingly different than what we've had last couple of years. 2021, it was about survival of the economy. You coming out of that COVID crisis. So the government had to stimulate the economy and they did the right thing. Then was about revival. And 2022 budget was all about revival. And that's what the government did. They increased their expenditure. The budget was a absolutely growth dominated budget. And this year the backdrop is that global macro is challenging. Inflation stroke recession concerns, they coexist. And looking at India's positioning, what this budget can do so that India can really take a giant leap forward. So that in a sense is the backdrop. The view of the market is that there are big standout points. One, advanced direct taxes, where the numbers would be strong. Second, for next year, the food subsidy bill food subsidy and the net subsidy number will be much lower. So this year's budget from a market standpoint and from an economy standpoint, I think would be a budget which would be a growth dominated budget. The 3 C's which really matter from a market standpoint are: number 1, consolidation, fiscal deficit; number 2, capex, which is growth stroke having a multiplier effect; and third is capital good tax. We'll talk about it. But Nantara, the backdrop, I guess, this time around is very simple, that what can be done in this budget so that India can take a giant leap forward. And the positioning of the economy and the positioning of the world is such that we are in such a sweet spot that if the budget is growth dominated, if there are no taxes, if the entire momentum is maintained from the government on the capital expenditure side, markets would really welcome this budget.
Absolutely, and it's budget week, Nikunj, and we'll go into the D-Day with Monday, the closing being below 18,000 for the Nifty and 60,000 for the Sensex. Everyone's expecting a growth-oriented budget. Maybe some changes in the bottom of the pyramid as far as the taxation goes. Maybe the markets will even lap up status quo. Having said that, coming back to the markets, Nikunj, and the reason why the markets are also maybe trading with the Nifty below 18,000, the Sensex below 60,000, the carnage that started last week was, of course, with the Adani group of stocks. We saw some momentum coming back. That FPO now, 3% is the like of subscription. But you're also seeing foreign investors like Abu Dhabi Holding Company issuing a statement talking about how they're going to be investing $400 million. How should the markets be seeing all of this?
Nandana, the comment or the confidence which the management of Adani has exhibited that, look, we are not going to change our price, we will not delay our FPO, and we are very confident it will sail through. So markets, I think, in a sense, are convinced that the Adani FPO will sail through. But if the Adani FPO sails through, what happens to the underlying stock price of Adani group of companies? And even if the FPO sails through, which there is a if it sails through, I don't think Adani group of stocks are just going to come back and they will see a V-shaped rally. That's because there are a lot of technicals which are at play. These are the halo stocks which were extremely overbought. They only saw one side move between 2020 and 2021, and when a crowded and overbought trade like that reverses, and when the fall is so sharp, buyers will not come back in a hurry, because that there is a change in the rhythm and there is a change in the momentum. So even if the FPO sails through, Adani group of stocks may not qualify as stocks which will say a V-shaped rally. However, if the FPO sails through, one would imagine that somewhere closer to the current levels, you may find stability coming back to some of these stocks. If you're buying into Adani group of stocks, you really have to take a long-term view, because mathematically, excepting, let's say, Ambuja or Adani Ports, some of the other stocks are, let's say Adani Enterprises, there's an asset owner. You cannot take a view based on 6 months or 1 year. You have to take a slightly long-term view. Adani Green, still you have to understand that where the business is moving, so you again cannot take a short-term view. Ambuja and ACC, well, they have a listed history. Their future, their price action once the stock stabilizes would be a function of what happens in the cement industry. So you really have to look at Adani group of stocks case by case, and my sense is that even if the FPO goes through, you may not see a really V-shaped rally in some of these stocks, but surely you would see some stability.
Okay, let's also just run you through a quick glimpse of the global setup. You did see Wall Street, which was on the back foot yesterday. The Dow Jones was down about 260 points. You also had the S&P 500 and the NASDAQ that wrapped up the day in the red. And during the regular trading session as well, we did see a little bit of choppiness and volatility. Do remember that we are awaiting what will later emerge from the FOMC meet. It's also going to be busy with respect to the earnings calendar. And this morning, you've got the Asian screen as well, which continue to look mixed, barring the Hong Kong markets. The rest of Asia continues to remain in the red, and China has reported growth in their manufacturing activity. A quick check-in on the SGX Nifty. It's an indication of a positive start this morning, mildly so though at about 17,795. It's up about 0.5% or so. But the other big pointer that we're tracking, and we're in the thick of it, is the earnings season. Lots of big nifty companies coming out with their numbers yet again today. So you've got from the pharmaceutical space, Sun Pharma, that will be coming out with its numbers. We'll be mapping out the US sales growth and domestic numbers. Coal India will be closely watched out for, Power Grid, as well as UPL. So Nikunj, a very close eye on a whole host of these earnings.
Avan, earnings, and even though they're Nifty 50 companies, that's really the sideshow today. I think markets in a sense right now are only focusing on two things. One, when and where will Adani group of stocks stabilize? The collateral damage what they've had, what would be the domino effect of that? That's theme number one. Theme number two really is budget and LTCG, and that is the other aspect which I think markets would only be focusing on. From an earnings standpoint, I think Sun Pharma and Coal India are the two ones which stand out. Power Grid is not really a stock which can be is not a stock where you can really make a view based on every quarter. UPL, I think, still has to demonstrate stability in their number before markets get convinced that all is well in for UPL. But Sun Pharma, I think, somewhere is the dark horse, because Sun Pharma has been in performing stock. Given that what we've got from Cipla and Dr. Reddy, and how brokerages are now coming out and indicating that the worst of the fall in pharma is behind as well. For Sun Pharma, the quarter gone by would be an interesting one, because they got an US FDA alert because of Halol, but their domestic business is looking strong. A little bit of pricing power seems to be coming back. So from a number standpoint, Sun Pharma number, I think, would be the talking point. But barring that, from an earnings standpoint, I think markets will really overlook a lot of numbers today. A lot of stocks where on a normal in a normal market action which have attracted attention, I think markets are likely to give it a pass.
Okay, so that's the trade setup as we head towards the opening bell with our managing editor Nikunj Dalmia. We've discussed it all, from budget to the Adani group of stocks to earnings. Now stay with us, and we're going to continue going to give you market voices as well. But Nikunj, before we do that, the markets always watch out for capital gains. There's always so much chatter that is there before the union budget day, that what's going to happen with capital gains. There's one theory that why should it be disrupted when you've got one of the best performing markets in the world? The second one being maybe the tenure could be tinkered with.
So Nayantara, you must understand the backdrop. And the backdrop here is that the fiscal position of the government is much better than what we've seen in a long time. I think this is the best fiscal position what we've seen. Now, if the backdrop is that if the fiscal position is strong, is there need for an additional tax? Now, you can argue about good to have tax, because then you are bringing all asset classes under one gambit and the tax simplification is there. But one is good to have tax versus need to have tax. So simplifying the capital gain structure and bringing equity at par with other asset classes, I think is good to have. But there is no really need to have it right now, considering that the global headwinds are there. B, the equity culture in India just about has started. C, we've seen what's happened to the financial markets, at least in last couple of days. Now, in this tax, even if it is imposed, Nayantara, it's not going to be really changing the entire tax collection by a mile. However, if the taxation structure is changed on long term or short term, it may actually have an impact on market sentiment, looking at how the market currently is the entire market right now is looking weak. So it may not be a tax which may give government a lot of tax collection. However, this also could have an impact on the market sentiment per se. I've always maintained that equity as an asset class is always a volatile asset class, so it needs to be given a preferential treatment. I think STT has worked like a charm for the government, and if long-term capital tax or short-term capital tax structure is changed, it really may have an impact on the aggregate STT collection also. So we can argue about the spirit of why the tax simplification would be done. It's a good hygiene to have, but there is something called need to have versus good to have, and I would say right now there is no need to really change the capital gain tax structure.
Yeah, that's exactly the view coming in from Punita Kumar Sinha, who we spoke with yesterday, managing partner at Pacific Paradigm Advisors. She doesn't see any particular need for a change in the tax regime, saying that the markets will be impacted negatively if there are tax hikes in the budget. Let's listen in.
Well, I don't see particular need for any change in the tax regime, other than the fact that, globally, as I mentioned, US and some of the other markets, the rates are a lot higher than what they are in India. So if the government has some plans to invest somewhere else and they need to garner more resources, then this is a place where they could easily think of, given that we are below a lot of global markets in terms of our um, capital gains rates. So that's the only reason I would see them wanting to do that, is to use the money for some other projects or other allocations in the budget.
This week, of course, a big one with what all is unfolding, whether it's the Adani Group of stocks, the thick of earnings season, and the big day tomorrow. We've got less than 27 hours to go before Finance Minister Nirmala Sitharaman stands on the floor of Parliament. The other big cue that the world is going to watch out for is the US FOMC outcome. That, of course, is going to be on Wednesday night. Our markets will react to it on the 2nd. Now, having said that, what's the kind of commentary that's coming out going into that big event? Every morning, my colleague Anisha Jain wraps up the global market action for you all and the important commentary you need to watch out for. Good morning, Anisha.
Hi, good morning. Let me start just with that as to what the street is expecting when it comes to the FOMC meeting. And Mohammed Al-Arian believes that most likely we'll see a 25 basis point hike coming in. But what he's suggesting is that perhaps the Fed should bite the bullet and take a 50 basis point hike, because he believes it's better to get the pain out of the system. And he says, I'd rather be done with the rate hikes out of the way now that the wait when the economy may be weaker itself. So that's the word coming in from Mohammed Al-Arian. And this is mirrored by what is happening with respect to rest of the participants as well, because if you look at the CME survey, 99.1% people believe that there will be a 25 basis point hike come tomorrow evening, and only 0.9% believe that there might be a case for 50 basis point hike. Let's see what actually gets delivered tomorrow. Separately, as far as the commentary is concerned from Universa Investment, they say that ballooning debts across global economy are poised to wreak havoc on markets, signaling even the Great Depression. And they said that this is the greatest risk that they have seen, perhaps greater than what we saw in 1920, and the consequences weren't that great. So watch out for what's happening with respect to global debt as well. Talking about the global economy, well, IMF came out with the latest revised forecast. This is the first time that they have upgraded the targets in a year. In fact, for 2023, they revised the global growth forecast higher to 2.9% versus 2.7% earlier. However, for 2024, the global growth of GDP has been cut to 3.1% versus 3.2% that was expected earlier in the month of October. However, India remains the bright spot yet again. They have not changed when it comes to India, the estimates as well, because they're expecting a 6.1% growth in 2023 and 6.8% growth in 2024. And the entire thesis being there is a bit of resilience when it comes to US demand. Chinese economy is opening up while higher interest rate as well as risk of inflation continues to persist. But there are some green shoots as well, and that's why we are seeing the first upgrade coming into the revisions in over a year. Back to you.
Powered by 1 billion consumers, India has now emerged to be the world's fastest growing large economy. In this budget, will the Finance Minister announce measures and policy initiatives that will boost consumption in India? Join me, Nilesh Shah, as I analyze the budget on ET Now.
All right, let's focus technicals then. Bring on board Naresh Mirani as well as Kunal Botra, who's back with us in our studios. Welcome back, Kunal. And I think the markets are also ushering in your welcome, because there was that pullback after a pretty terrible Friday's trading session. So what exactly is it that you're watching a day ahead of the big event? What are you advising people to do in terms of positions?
See, I think the major part of the volatility now seems to be behind us. I think the last 3 or 4 days we've seen a very sharp correction of sorts for the indices. Nifty down more than 500, 600 points. Bank Nifty down, I think at one point was more than 4,000 points, from 43,000 to almost 39,400 odd levels. Now, the intriguing part about the markets are two-faced. One is on the open interest built up. So we tend to see how the, when the indices go into a corrective mode, whether there's been a built up of open interest or whether there is a reduction of open interest. That generally tells us whether the bent of the market is more towards building of short positions or squaring off of long positions. Now, the intriguing part is that on the Nifty, we've seen some unwinding of short positions. For example, yesterday we saw the open interest drop by around 4.5% on the Nifty. But the worry for the markets would be the rising open interest for the Bank Nifty, which is still at a higher level for the banking index, at least over the last 30-40 trading sessions. The other part to look out for is the mid-cap breadth of the market. The only solace for the market so far is that the mid-cap end of the market, the Nifty 500 as well as the mid-cap 50, the market breadth over there has entered into a deep oversold territory. So that I believe could be an intriguing factor. As of now, I would believe possibly the market may not be as volatile as what one would probably expect. But then I think largely 17,500 to 17,800 could remain a range for the Nifty.
17,500 to 17,800, the range for Nifty as we head towards Union Budget. That's the word coming in from Kunal Botra. Naresh, what about you? What levels are you watching out for? And of course, let's talk about the Bank Nifty as well, which seems to be stubbornly stuck now at 40,300.
So yesterday was a good candle or the good price action in terms of what we call as a doji candle. The index went on both the sides. In the previous two sessions, what we had generally seen is only a one-way correction. So yesterday was a good intraday recovery, and all through the day we saw a retest of the lows, then a recovery. So classical, say a formation wherein now what we need is a confirmation above the yesterday's high, a close above yesterday's high. So that would be say 40,800 on the Bank Nifty, and say somewhere closer to 17,720 for the Nifty. Once we do that, that would be a confirmation of a short-term bottom. So overall, a bottoming out case, and the view remains the same. Post-budget, we should see a better rally, and this budget seems, the price action seems very similar to 2021, wherein going into budget last 4-5 sessions, we saw a downtick. And post-budget, if there is nothing untoward coming out of it, we could actually see a quick rally. And the small cap index yesterday also gave an indication by not breaking the lows of the previous day. That was the first indication that there is no panic in the broader markets. Rather, the panic is more in the heavyweights. So overall, all the things point to a bounce post-budget. And today we could see some bit of, say, volatility in the last 30 minutes, which could be due to the last trading day of the month. There could be some ETF downtick or uptick. Apart from that, from tomorrow, I would expect better days.
Okay, that's the view coming in on the markets. Let's find out those individual stock recommendations and top ideas. And Kunal, take us through your buy list.
So I'll go with a lot of large cap names, two large cap stocks which I would recommend. The first one is about TCS. That stock is looking attractive, targets of 3,550. So expecting at least another 120 points on the upside over the very near term. Stop loss for this trade is around 3360 mark. And surprisingly, the auto stocks have been very, very resilient. And I think Maruti has been one stock which has managed to make a lot of comeback for itself from 8,300, 400 levels to now 8,800 plus mark. So would suggest that as a buy, 9,000 as an immediate target, stop loss at 8680.
And what about you, Naresh? I believe you also have all buy calls.
Yeah, so all buy calls focusing on the banks. State Bank of India has corrected from 620 levels all the way to 530, 540. A good correction done, retesting of the previous breakout, expecting it to be a bottoming out case here, a stop loss at 525 and a target price of 600. Second is a buy on Axis Bank, which is coming back to that 830 to 870 band, which is a strong support area. This is where it broke out from. There was a Sooty stake sale around these prices and a couple of block deals. So a good band of area to accumulate. So a stop loss at 830 and a target price of 950.
Okay, so that's the buy call on both SP as well as Axis with the stop loss for you there with Naresh Marani. We're going to take a short commercial break, but stay tuned. There's so much more to talk about, money-making ideas. It is, after all, budget week. We'll also get to a special conversation with Ace Investor Madhu Kela. That and more. Stay tuned.
Welcome back. Let's focus in on big earnings. Yesterday, post-market hours, engineering and construction major L&T came out with their numbers. The Q3 earnings were in line with street estimates. Profits came in at around 2,500 crores. That was growing about 24% on a year-on-year basis. Revenues at 46,000 crore rupees, with margins a tad bit below street estimates at 10.9% versus our estimates of about 11.5%. The company reported a 4% increase in the order book, and that stood at about 3.87 lakh crore rupees. They received orders worth about 60,710 crore rupees, and the profits this time around included an exceptional gain of about 97 crore rupees. Not just that, you also had the company that was in the spotlight in their analyst call. They said that they are well positioned to meet and exceed the upper band of the order and the revenue guidance of 15%. They also said that if the ordering momentum continues, that is when they will exceed that order flow guidance. The guidance of 12 to 15% is being maintained both on revenue and order inflow. And for FY23, they expect pressure on the margins of 30 to 50 basis points compared to 9.3% in FY22. In terms of the brokerages then on L&T, Goldman Sachs has maintained its buy rating with a 25.50 rupee target price, saying that it has been strong results and a positive order execution. The lower core margin guidance has been a disappointment. Jefferies also has a buy rating on the stock with a target price of 26.50, saying that Q3 reflects the beginning of the upcycle benefits and that the 9-month order inflow has been strong. Valuations point to re-rating in a historical context, according to Jefferies. Let's hear it out as well then from the management of L&T, R. Shankar Raman, saying that the company has fired on all engines when it comes to revenue, order inflow and profit.
So taking in this quantum of orders that we have booked during the current year, the order book per se as of December 31, 2022 has grown to 3.86 trillion rupees. This is the highest ever. It's grown by 14% over year-on-year basis. The share of the government and the public sector orders within this order book is about 75%. 72% of the order book is from infrastructure segment and 20% of the order book is from the energy segment, mostly hydrocarbon. So bulk of the order book that we have are in areas where there has been significant attention paid for project completion by the project sponsors. And that augurs well for the revenue visibility of the company looking ahead. Going forward, we do find the order pipeline for the rest of the year is encouraging, and we hope to take advantage of the ordering momentum if that sustains the pace at which Q3 had witnessed.
Okay, that's L&T, which fired on all engines. Watch out for that stock as well. It's certainly going to be in focus. Digandharya now here with us live. Good morning. So it's a big week. Earnings, union budget, the US FOMC meet, and we're going into it with the Sensex below 60,000 and the Nifty below 18,000. Give us 2 or 3 specific, stock-specific money-making ideas, because the fact is you've seen a carnage going into all of these big events this week.
Yeah, I think, Jan has been a pretty bad month for India, so to say, either from the index standpoint or from the FII flows. I think this whole banking sector leadership, which was driving till December, I think that took a little bit of knock in Jan. One clear trend which I can spot is that last 6 months or 7 months, the banking sector, within the banking and financial sector space, the public sector was leading the pack, be it the smaller banks like Union or Punjab National Bank or, Canara OPC. I think, now, it's probably time that this leadership will change to the large private sector banks. We've seen quite a bit of underperformance from, say, an SBI, from ICICI or Kotak or HDFC. So I think that is where, I'm expecting some action to happen in the next few months. And secondly, I think the budget is going to be all about infra creation and, focus on building physical assets in the country. So this entire industrial capital goods space, infrastructure building space, I think that's a space which can do well, probably better than the banking sector as well. So I think these are the 2 pockets where we have, trained our eyes on.
All right, let's connect with Digant Haria, co-founder GreenEdge Wealth as well, who's joining in on the show. Digant, good to have you on board just a day ahead of that all-important budget. And while the expectations are rife this time around that, it could yet again be a growth-oriented budget, largely on the back of the fact that we've got a backdrop of worsening macros as well as high inflation. Do you think that there is going to be focus on consolidation, capex, as well as capital gains this time?
I think see, India really does not have an option but to have this whole capex growth story. Our consumer growth story has, as it is, slowed down. We had very little capex from say 2014 to 2020. So I think capex, there is no debate that we need capex, and the government focus is very much going to be there. Be it the electricity sector, be it the roads, be it the railways, be it the ports. I think that there we don't have a choice. And when you are building physical infrastructure in the country, I don't think any governments can afford to spook the capital markets with increase in the tax rates, or tampering with things which do not really make sense. See, we had like 6 crore new demat accounts being opened. So a lot of people are getting excited about the markets. Retail money is coming in. FIIs, like they see India as a very good option for their investments. So I think there is no case to, tinker with the capital gains tax. As it is, the government is flush with a lot of revenue, and the fiscal deficit targets, it got extended by 3 more years because of the COVID. So I think we are in a pretty good position to drive this whole capex and growth-oriented reforms in the budget.
Digant, obviously everyone is expecting all of that, but having said it, in the introduction you also said banking, which was the prized pack last year, the way it ended, has come under pressure. So tell us stock-specific ideas. Today we have Nuresh on the panel who was going big on SBI and Axis for today's trading session. But after the sell-off and after what you've seen with the PSU banks, also the run-up that you've seen, where would you put your money? What would you buy?
Yeah, so I think see the two big themes in 2023 for the banking sector. One will be that we no longer have low interest rates, we no longer have easy liquidity. So cost of deposits is going to be one real challenge in the year 2023 because liquidity is tighter globally and in India, and you also have loan growth coming through. So I think in such an environment, you have banks which have very good liability franchise. Those will do well. So ICICI Bank, comes right at the top end of this. We've seen good correction. The stock has gone nowhere for close to 15 months now. So I think this, once FI selling subsides, I think there's everything right going on with the banks. So it's just more of this whole FI selling, which is keeping the stock under check. So ICICI Bank, then you have Axis Bank, it's quite cheap, delivering well, turning around. So maybe, a large upside is there because there's a valuation upside also which one can catch. But beyond these Axis and ICICI, I think even HDFC Bank has undergone a nice, kind of consolidation. The merger is on track. And despite, all the challenges, they've been able to grow around 20%. Kotak had surprised us with more than 20% growth after a very long time. So I think this whole pack is looking good. Go ahead, pick whatever whatever you're comfortable with. I think the whole pack is destined to do well in the next 12 months. And within the PSU pack, I think my pick will be the same as the one with Nuresh, which is SBI, because they really have a good liability franchise and they have good capabilities on the retail as well as corporate side. So SBI is a good mix of a lot of these things. Undergone a big correction because of the controversies going on outside of. So yeah, I think these 3 or 4 names could really fire up the portfolios in the next year.
Budget Master Contest is back and it's raining gold this time around. This budget day, grab your chance to win gold vouchers. Stay tuned with ET Now from 9 a.m. to 2 p.m. on 1st February. Catch the question flashed on your screen. SMS your answer to 56161. Win big. Budget Master Contest. Only on ET Now.
Digant, we are more than halfway in the earnings calendar. Bank numbers are out. We've got number from L&T. Tech, pretty much the entire pack is out. Which to your mind is a standout number this quarter?
Is this question for me, Nikhil?
That's right, Digant.
Yeah. Okay. So I think banking and industrials or the capital goods space, they really stand out in terms of numbers. Right from right from something like a South Indian bank, which nobody talks about, to something like an ICICI or HDFC. Everything gave good results. It's just that this is a over-owned sector, and which is why whenever FI selling happens, this is a favorite sector to get sold into. So this has not done well despite the whole good results. But yeah, I think it's a matter of time that the selling gets absorbed and this does well. Capital goods, I think beyond L&T, there are so many smaller companies like CG Power. They reported like blockbuster numbers on a blockbuster base of last year as well. Then you had Kirloskar Pneumatic, Bharat Bijli, numerous examples. So I think while L&T is the bellwether of this sector, but the real party is below L&T, where we see strong numbers, strong order book, strong commentary, even margin expansion. So I think these two sectors really stand out. The third one, which kind of gave better results than expected, was the whole IT pack. I think we were all expecting that because of the slowdown in the developed world, the commentaries would be loose, but that did not happen, and I think that's one surprise in the whole result pack which has come out.
Okay, I just want to go back to CG Power, and we don't talk about CG Power, but trust me, it's a business which has gone through ups and downs, twists and turns, and then a promoter exit and a new corporate group now owns CG Power. Now, Patricia knows me so well that before I could even request for a graph here, she's pulled it out. Patricia, by the way, is our producer. Digant, since you spoke about CG Power, the stock is up 30x. 30x irrespective of what's happened in the world. 5 rupee stock has become a 300 rupee stock. From 300, where can it go? Will it become 100x before it tops out, or it's going to top out sooner than later?
See, Nikunj, so the way I look at CG Power is they are mainly into motors and transformers, and the components which are used in any industrial setup. So motors, in a factory, you need to replace motors again and again and again. So it's a business which is sort of a consumer business. When I talk about a B2B business, that you have a very good brand, and people know you, and people have your motors already in your factory, and they would want to replace only your motors with their existing motors. So it's in a way a very rock solid, very long term business. See, the previous promoters had a problem of over leverage, so it was always a 100 rupee business which went down to 5 rupees because of the debt crisis, and everything got accelerated during ILFS. New management is a Murugappa management. We have seen how they've turned around Chola, over the last decade. That's a management which is very clean, strong balance sheet, new products. They have launched so many new products in the last 2 years of just taking control. So I think CG Power, at these levels, it's very difficult for me to say buy. But if somebody has it, you should ride along as long as the whole capex cycle is going on. And beyond the capex cycle, management is launching motors for electric vehicles, and they have products for railways. This Vande Bharat, they are doing a lot of things for Vande Bharat. They are doing things for the renewable energy transformer. So I think you get a lot of themes packed into one in this stock. Obviously, market is excited about this, and that's why the stock is 30x. But maybe 3-4 years later, who knows, this stock can be much, much, much higher than where it is today if the execution is good, if the capex cycle is good. So yeah, Nikunj, I think Bharat Bijli, Oldtime are smaller brothers of this company, and that's where there's some valuation comfort that we have.
Kunal, let's get in a take on the charts then. BEL, clearly the street seemed to be disappointed with the kind of earnings that it delivered, and the stock came under quite a bit of pressure in trade. And then there was Hindustan Zinc as well, one of the other Nifty 500 losers. Your view?
So I think both the charts are a bit different from each other, because BEL is a stock which I think had topped out 3-4 months back, in the month of November and December start. I think that stock is now getting into a phase where it's completed a mean reversion. So, when a stock gets into a sudden corrective phase, that's a point where we try to change the stance from being an initial buyer to being on the sidelines. But I think now after this correction, which has already started for BL 3-4 months back, I would be of the view that possibly the stock may get into a near-term support zone. So I think a buy and dip strategy over here could be a very good strategy which could turn out for BEL. Hindustan Zinc could be a different ball in the game, because I think that stock has just suddenly gotten to a reversal phase. It's not yet completed a mean reversion towards the 200 DMA. The last time, I think the last week high for the stock was around 360 odd mark. It's come back towards 330 levels. I believe potentially that the stock should come back towards 300 before the correction subsides for Hindustan Zinc. So I would wait out for a while for Hindustan Zinc, but I think for BEL, I think traders could look at start buying at current levels.
We discussed Sun Pharma with Nikunj. It was part of his editor's take when he talked about earnings and the markets, but I wanted to do a technical check on it. Kunal, tell us, Sun Pharma, which also scaled to a new 52-week high yesterday.
So I think it's a very interesting chart, Nayantara, because, I look at it from the last 5-7 years of charts for Sun Pharma. 2015 is where the stock had made an all-time high of 1200 approximately, corrected towards 350-60 mark. I think in 2018-19, and then from there on, the stock has come back towards that 1050 plus mark for itself. So I think what stands out for Sun Pharma is this huge V-shaped recovery, or sort of a U-shaped recovery over the last 5-7 years for the stock. Now, interestingly, the near-term charts for Sun Pharma as well are indicative of a inverted head and shoulder pattern, which is again a bullish formation for Sun Pharma. We add to the fact that the markets have been very volatile, and apparently this stock has not gone into a corrective phase. In fact, it's seen a lot of buying, so there could be another risk aversion phase which could probably be leading towards buying defensives as well as large cap names like Sun Pharma. So when you try and look out for all of these patterns, it indicates that this momentum should sustain for Sun Pharma, and it's more of a gradual kind of an up-moving stock. So you don't expect stellar up move over the very near term, but I think for a trader who has a 3-month kind of a time frame, I think from here on, looking out for another 100 rupees on the upside, which should be potentially 10%, could be a high probability trade.
All right, in the meantime, let's hear it out then from market veteran Madhu Kela as he walks us through what he thinks is in store for the budget. This is going to be a special interaction, and we'll have the full conversation play out later on the show.
Every time when budget is round the corner, budget is also about taxes. We tend to discuss from a stock market side the importance of rationalization of taxes. In India, just to break it for our viewers, we've got different tenure and different tax rates. Different tenure if you're holding in equity, debt, real estate and gold. Similarly in India, if you are trading in F&O, different tax rate. If you're holding for more than 1 year, different tax rate. If you're holding for less than 1 year, different tax rate. Market nervousness, Madhu, perhaps is valid because the tax regime is different. There are two ways in which things could happen, and I'm just going to project it for our viewers. The short-term rates in India are 15%, long-term is 10%. If the short-term rate is changed in proportion with business income, will that be a negative news for the market?
So, Nikunj, let's first look at it. You be in finance minister situation. Capital markets have enabled raising of 6.5 lakh crore rupees of equity in the last 3 years, right? I would urge and pray that these things should not be disturbed, at least this year, because everything is going well. Capital market is helping revive the economy. Revival of the economy, given the global context which we discussed, is very, very important. So I think any meaningful distortion on the capital gains tax regime may not get government significant revenue boost up, and as we discussed, it is not even needed. If they get 10,000 crore extra, that is not even needed. So I think this thing can wait, and it should wait, right? There is a merit in rationalizing the taxes, but should it be done this year is my point. I am saying that logically speaking, given the context that markets have also become nervous, given the context that there is talk of global recession, and we need very healthy capital markets, it should not get distorted. Having said this, if the time frame changes, let's say it long term goes from 1 year to 2 years.
That 1 year becomes
Okay, so that's Madhukela, and we will, of course, be getting you the full interview right here on ET Now. It's also on our social media platforms. But let's stay with stocks that we've seen buzzing over the last couple of days. And Naresh, let me come to you for this one. You know, we saw the new age companies being battered out of shape. Still then, last week we were seeing Nykaa being a big underperformer. If you look at the last 1 week and the recovery that you've seen in Nykaa, and if you do a chart check, what does it indicate?
So until now, it's just a minor recovery of say 10% from the lows. It's too early to call for a bottom, or rather, we need to spend a lot of time in a bottoming out formation. So the only stock, say for example, if you want to look out what is a bottoming out formation, is Zomato. The stock earlier made a bottom at 50, then made a low at say closer to 40, went back to 75. Now we are back to that 45 to 50 mark. And this is the kind of formation which continues for months together. And now we could be getting towards a bottom formation in Zomato. And if you look at Nykaa, we've just spent a few months or maybe a couple of months in this downtrend, which has been sharp. But we need to form multi-month consolidation zones before we call it a bottom. So Nykaa is too early, but if somebody is looking out for a possible bottoming out formation, it is Zomato and the new age companies.
Meantime, just let's check in on the other big result candidate. Then yesterday you had Tech Mahindra as well that came out with its numbers. It was a pretty decent set of earnings, better than what the muted street expectations were. Cross-currency growth at about 0.2%. The profits at about 1287 crore rupees. The dollar revenues coming in higher by about 1.8% sequentially at $1,668 million. The Q3 attrition stood at about 17% versus 20% on a sequential basis. Kunal, let's get in a take on Tech Mahindra on the charts as well as L&T post its numbers last evening.
So L&T could be interesting. I'll start off with that. I think because that stock was one of the leaders over the last 1 or 2 weeks, specifically just before this correction in the markets. I think L&T was one of the stocks which managed to hit not just a fresh high for itself, but the way in which the stock managed to lead up was more of a confidence booster for the entire market. So I would be of the belief that possibly L&T could probably get into some sort of a bounce over here. The correction may not be very steep, and in case if the stock corrects, I think that should be an opportunity to buy. Tech Mahindra, I would be a bit circumspect because when you try and look out for the IT stocks, the first basic criteria which we look out for is that whether these stocks have been able to surpass above their 200 DMAs. In fact, Tech Mahindra over the last 3 or 4 months has been unable to surpass above its 200 moving average. Yes, there have been multiple attempts where the stock has tried to claw back above the 200 DMA, but it's failed to sustain those levels. So we'll have to wait out for a confirmation point. Now, in that regards, a better outperforming stock would probably be the larger cap names like HCL Tech, TCS. These stocks have actually confirmed a breakout above their long-term averages. And I think that's a much better bet rather than Tech Mahindra at this point of time.
Okay, that's Kunal preferring HCL Tech over Tech Mahindra, which came out with the numbers. In fact, here's the top management on not just the quarter gone by, but going ahead, what it's looking like from order pipeline to the quantum of the deals as well.
Overall, as I would submit to all the viewers, is 800 million of large deals in this quarter signify that we are able to deliver on the large deal commitments that we had made. Number two is when I look at the overall funnel, I think the company is doing extremely well. In terms of discretionary spend, yes, we see softness in the market, but my opinion is it's a temporary softness. But as a management team, we used to work on a 3-month forecasting cycles. We have now started our budgeting, business planning exercises based on the feedback, based on listening to our customers. We have decided to become more agile and become, bring in our cycle time to every month. So which effectively means is whatever feedback we get, we will be taking corrective action within the company on a real-time basis.